Should you invest in Japan? Everything you need to know about Japan ETFs. Hey everyone, and welcome back to Chat ETF. Today, we're diving into the fascinating world of Japan ETFs. Japan's economy might not be the flashiest, but it holds hidden potential for savvy investors. From robotics and clean energy to established giants, Japan offers unique opportunities through exchange-traded funds, or ETFs. Can Japan ETFs help you diversify your portfolio? Can they outperform the market? Stick around as we unpack everything you need to know about Japan ETFs in the next exciting video. Question 1. What exactly are Japan ETFs? Japan ETFs, or exchange-traded funds, are investment bundles that specifically target the Japanese stock market. They pool money from various investors and use it to buy a basket of stocks traded on Japanese exchanges. This essentially allows you to invest in a slice of the Japanese economy with a single purchase. Here's a breakdown of key points about Japan ETFs. Exposure to Japanese stocks. By investing in a Japan ETF, you gain exposure to the performance of multiple Japanese companies, offering diversification and reducing risk compared to buying individual stocks. Tracks an index. Most Japan ETFs track a specific index, like the Nikkei 400 or the MSCI Japan Index. This index determines the companies the ETF invests in and their weighting within the fund. Trading like stocks. Japan ETFs trade on stock exchanges, just like individual company stocks. You can buy or sell shares throughout the trading day. Think of a Japan ETF as a basket containing various fruits from a Japanese orchard. Instead of picking individual fruits, stocks, you buy the entire basket, ETF, getting a taste of different varieties, companies, within the Japanese market. Question 2. How do Japan ETFs work? Here's how Japan ETFs function. 1. Tracking an index, or strategy. Most Japan ETFs follow a predetermined index, like the Nikkei 225, or the MSCI Japan IMI. This index dictates which Japanese companies the ETF will invest in and how much of the ETF's holdings will be allocated to each company. Some ETFs might have a specific investment strategy besides following an index, like focusing on specific sectors or high dividend-paying companies. 2. Fund management. An asset management firm oversees the Japan ETF. They are responsible for buying and selling the underlying stocks, or assets, according to the chosen index or strategy. They also manage the overall portfolio and ensure the ETF adheres to its investment objectives. 3. Shares and trading. The ETF creates and issues tradable shares, similar to individual company stocks. Investors can purchase and sell these shares on stock exchanges throughout the trading day. The price of the ETF share fluctuates based on the combined value of the underlying holdings. 4. Expense ratio. Like any investment, Japan ETFs incur fees. The expense ratio is an annual percentage cost that covers the ETF's operational expenses, including management fees and administrative costs. 5. Dividends, optional. Some Japan ETFs distribute dividends received from the underlying stocks they hold. This provides investors with a passive income stream. However, not all Japan ETFs distribute dividends, and it depends on the ETF structure and objectives. In essence, a Japan ETF acts as an intermediary, allowing you to invest in a diversified basket of Japanese assets through a single share purchase. The ETF itself does not actively manage the holdings to outperform the market. It passively tracks the chosen index or strategy. Question 3. Why should investors consider Japan ETFs over other investment options? Investors might consider Japan ETFs for several reasons. Diversification. Japan ETFs offer exposure to a range of Japanese companies, reducing risk compared to picking individual stocks. This diversification can be particularly attractive if the rest of your portfolio focuses on different markets. Potential for growth. The Japanese economy has shown signs of recovery, and some sectors like technology and robotics hold promise. ETFs can be a good way to tap into this potential growth. Currency play. A weakening yen can benefit Japan ETFs. If the yen weakens against other currencies, the value of the ETF's holdings in yen becomes more attractive to foreign investors, potentially driving the ETF price up. Carry trade opportunity. Japan's low interest rates can be appealing for carry trade strategies. This involves borrowing in yen, with low interest rates, and investing in higher-yielding assets elsewhere. While not directly related to the ETF itself, it can boost investor interest in the Japanese market. Political stability. Japan is known for its political stability, which can be a plus for investors seeking a safe haven for their assets, especially during periods of global economic uncertainty. Exposure to specific sectors. Some Japan ETFs target specific sectors, like healthcare or technology. This allows investors to focus on areas they believe have strong growth potential within the Japanese market. Question 4. Are there different categories of Japan ETFs, and how do they differ? There are various categories of Japan ETFs that cater to different investment styles and goals. Here's a breakdown of some common types. 1. Broad market ETFs. These ETFs track broad market indexes, like the Nikkei 225 or the Topix. They offer general exposure to a large portion of the Japanese stock market, capturing the performance of leading companies across various sectors. Examples: iShares MSCI Japan ETF, EWJ, Vanguard Total Japan Stock ETF, VTJ. 2. Sector-specific ETFs. These ETFs focus on specific sectors of the Japanese economy, such as technology, healthcare, or financials. They allow investors to target areas they believe have high growth potential, or align with their specific investment themes. Examples: SPDR SP Japan Technology ETF, GJM, iShares Currency Hedged MSCI Japan IMI Healthcare Sector ETF, HEWJ. 3. Small cap or mid-cap ETFs. These ETFs invest in smaller or mid-sized Japanese companies, offering exposure to potentially higher growth, but also higher risk compared to large-cap ETFs. They can be a good way to diversify a portfolio beyond established companies and tap into the growth potential of smaller firms. Examples: Russell 2000 Japan Small Cap Index ETF, IJR, VanEck Vectors Japan Small Cap ETF, GAA. 4. Dividend Yield ETFs. These ETFs focus on Japanese companies with a history of paying high dividends. They cater to investors seeking a steady stream of income from their investments. Examples: Wisdom Tree Japan High Dividend Index Fund, DHJ, Global X Japan High Dividend Yield ETF, JPHY. 5. ESG, Environmental, Social, and Governance, ETFs. These ETFs invest in Japanese companies with strong ESG practices, considering environmental responsibility, social impact, and corporate governance. They appeal to investors who prioritize sustainability alongside financial returns. Examples: iShares ESG MSCI Japan ETF, SUSJ, Franklin FTSE Japan ESG Select UCITS ETF, FJPJ. Question 5. What factors should investors evaluate when choosing a Japan ETF? Here are some key factors to consider when choosing a Japan ETF. 1. Investment objective. Growth. Look for broad market or sector-specific ETFs targeting industries with high growth potential if capital appreciation is your primary goal. Consider ETFs like EWJ or GJM mentioned earlier. Income. Explore dividend yield ETFs like DHJ or JPHY if you prioritize regular income generation from your investment. Diversification. If you aim to add general Japanese market exposure to your existing portfolio, a broad market ETF like VTJ could be suitable. 2. Underlying index. Research the index the ETF tracks. Understand its composition, sector weightings, and historical performance to get a sense of the risk-reward profile. 3. Expense ratio. Compare expense ratios of different Japan ETFs. Lower expense ratios mean keeping more of your returns. 4. Liquidity. Choose ETFs with a high trading volume to ensure easy buying and selling at minimal price difference. 5. Dividend distribution. Decide if you prefer dividend reinvestment, automatic purchase of additional shares with dividends, or cash payouts based on your income needs. 6. Risk tolerance. Broad market ETFs generally offer lower risk than sector-specific or small-cap ETFs. Consider your comfort level with potential volatility. 7. Currency hedging. Some Japan ETFs hedge against currency fluctuations. Decide if you want exposure to potential gains or losses from yen movement. 8. Investment time frame. Japan's economic growth can be slower than some markets. Consider your investment horizon and if you can handle potentially slower returns. Question 6. Are there any risks investors should be aware of when investing in Japan ETFs? Even though Japan ETFs offer potential benefits, there are inherent risks to consider. Slow economic growth. Japan's economic growth has historically been slower compared to some other markets. This could limit the overall return potential of Japan ETFs. Demographic challenges. Japan's aging population is a significant demographic challenge that could impact future economic growth and potentially strain social security systems. This could indirectly affect corporate profitability. Currency fluctuations. The value of your Japan ETF can be significantly impacted by currency fluctuations. A strengthening yen can erode the value of your investment, especially for unhedged ETFs. Passive management. Unlike actively managed funds, Japan ETFs generally track an index passively. This means their performance is tied to the underlying index, and they may not outperform the market, especially during strong bull runs. Political gridlock. While Japan is known for relative stability, political gridlock can sometimes impede economic reforms and slow down progress. Here are some additional risks to keep in mind. Limited market diversification. Compared to broader global markets, the Japanese stock market offers less diversification. This can concentrate risk within a smaller pool of companies. Sectoral concentration. Some Japan ETFs might be heavily concentrated in certain sectors, like technology or financials. This can amplify gains within those sectors, but also magnify losses if those sectors experience downturns. Geopolitical tensions, regional tensions, or global events can impact the Japanese market and your ETF's value. Question 7. What role do Japan ETFs play in a diversified investment portfolio? Japan ETFs can serve a valuable role in a diversified investment portfolio by providing several key benefits. Exposure to a different market. Japan represents one of the world's largest economies with a unique industrial structure and strong brand recognition in certain sectors like technology and automobiles. Including a Japan ETF offers diversification beyond your home market, potentially reducing overall portfolio risk. Potential for growth. While economic growth might be slower than some regions, Japan possesses a highly skilled workforce and a focus on innovation. Sectors like robotics and sustainability initiatives have shown promise, and ETFs can provide access to these growth opportunities. Currency play. Optional. If you believe the yen is likely to weaken against other currencies, a Japan ETF can benefit. A weaker yen makes Japanese assets more attractive to foreign investors, potentially driving up the ETF's price. Income generation. Optional. Some Japan ETFs focus on companies with a history of paying dividends. This can provide a steady stream of income for investors seeking regular payouts. However, it's important to remember that Japan ETFs also come with limitations. Limited diversification. Compared to a truly global ETF, the Japanese market offers less overall company and sector diversification. This can concentrate risk. Slower growth potential. The historical pattern of slower economic growth in Japan might translate to slower return potential for Japan ETFs compared to some other markets. Overall, Japan ETFs can be a good fit for a diversified portfolio if you seek exposure to a developed economy beyond your home market. You believe Japan has potential for future growth, particularly in specific sectors. You are comfortable with potentially lower overall portfolio volatility compared to some faster-growing markets. Question 8. For investors seeking income from their investments, how do dividend-focused Japan ETFs differ from broad market ETFs in terms of performance and risk? Dividend-focused Japan ETFs and broad market Japan ETFs offer distinct advantages and disadvantages for income-seeking investors, particularly regarding performance and risk. Performance year. Dividend-focused ETFs generally offer higher dividend yields compared to broad market ETFs. These ETFs specifically target companies with a history of paying consistent dividends, prioritizing income generation over capital appreciation. Broad market ETFs may have lower headline dividend yields, but could offer higher total returns over time. This is because broad market ETFs encompass companies that might reinvest profits for future growth instead of paying dividends. The potential for share price appreciation in these companies can contribute to greater overall returns despite lower dividend yields. Risk year. Dividend-focused ETFs can be more volatile than broad market ETFs. Since they target companies that prioritize dividends over growth, their stock prices might be less sensitive to market fluctuations. However, these companies might also be more mature and established, potentially facing slower growth prospects, which can impact stock price appreciation. Broad market ETFs generally offer lower volatility due to diversification across various company types, including growth-oriented companies. While dividend yields might be lower, the potential for capital appreciation through stock price increases can help offset this. However, these ETFs are still susceptible to broader market swings that could impact overall returns. Choosing between them here. Prioritize income. If your primary goal is generating a steady stream of income from your investments, a dividend-focused Japan ETF might be a good choice. However, be prepared for potentially lower total returns and higher volatility. Balance income and growth. A broad market Japan ETF offers a balance between income generation through dividends and potential for capital appreciation through share price growth. While the dividend yield might be lower, the total return potential could be higher over the long term, with potentially lower volatility. Question 9. Are there Japan ETFs that are actively managed by fund managers, and how do they differ from passively managed ETFs in terms of potential benefits and drawbacks? Traditionally, most Japan ETFs have been passively managed, but there have been recent developments. Here's a breakdown of actively managed versus passively managed Japan ETFs. Passively managed ETFs, more common. Function. These ETFs track a specific index, like the Nikkei 225, or the MSCI Japan IMI. The fund manager replicates the holdings of the chosen index, and adjusts them to mirror any changes. Benefits. Lower expense ratios. Passively managed ETFs typically have lower expense ratios compared to actively managed ones since they require less ongoing research and management. Transparency. The holdings of passively managed ETFs are publicly known, allowing for greater transparency. Market performance. They aim to match the performance of the underlying index, offering predictable returns that reflect the market's overall direction. Drawbacks. Capped return potential. Passively managed ETFs are capped by the performance of the index they track. They cannot outperform the market, even if the fund manager has good stock selection skills. Limited control. Investors have limited control over the specific companies held within the ETF, since they mirror the index. Actively managed ETFs, less common. Function. These ETFs are overseen by fund managers, who actively research and select Japanese companies based on their investment philosophy and analysis. The holdings are not tied to a specific index, and can be dynamically adjusted based on market conditions. Benefits. Potential for outperformance. Actively managed ETFs offer the possibility of exceeding the returns of a benchmark index, if the fund manager's stock selection and market timing are successful. Greater flexibility. Fund managers have more freedom to invest in companies they believe are undervalued or have high growth potential, offering more flexibility than an index-bound approach. Drawbacks. Higher expense ratios. Actively managed ETFs typically come with higher expense ratios due to the ongoing research, analysis, and management by the fund manager. Performance dependence. The ETF's performance relies heavily on the skill and experience of the fund manager. There's no guarantee of outperformance compared to the market or passively managed ETFs. Less transparency. The holdings of actively managed ETFs might not be disclosed daily, unlike passively managed ones. Availability of actively managed Japan ETFs. As of now, actively managed Japan ETFs are a relatively new concept. In 2023, Nomura launched the first actively managed Japan ETFs on the Tokyo Stock Exchange. It's likely more options will emerge in the future, but passively managed ETFs are still dominant. Question 10. How do smart beta Japan ETFs differ from traditional market cap weighted ETFs, and what are their potential advantages? Smart beta Japan ETFs offer a twist on traditional market cap weighted ETFs, potentially providing some advantages for investors seeking specific outcomes. Here's a breakdown of the key differences. Traditional market cap weighted ETFs. Function. These ETFs allocate holdings based on the market capitalization of the underlying companies. The larger a company's market value, stock price multiplied by outstanding shares, the greater its weighting within the ETF. This means the biggest companies in the index have the most significant influence on the ETF's performance. Example: an ETF tracking the Nikkei 225 would have the highest weighting for companies like Toyota, Sony, and Nintendo due to their large market caps. Smart beta Japan ETFs. Function. These ETFs go beyond just market cap when selecting and weighting companies. They follow a specific investment strategy, or smart beta, approach that factors in additional metrics besides market cap. This could include factors like profitability, volatility, quality, or dividend yield. Example: a smart beta Japan ETF might focus on value investing, giving more weight to companies with strong financials, but undervalued stock prices compared to their assets or earnings. Potential advantages of smart beta Japan ETFs. Enhanced diversification. By considering factors beyond market cap, smart beta ETFs can potentially offer better diversification within the Japanese market. They might allocate holdings to smaller or mid-sized companies with strong fundamentals that traditional market cap weighted ETFs might miss. Targeted exposure. Depending on the chosen smart beta strategy, these ETFs can provide targeted exposure to specific factors you believe will outperform the broader market. For example, a value-oriented smart beta ETF might outperform during periods when value stocks are in favor. Potential for risk reduction. Some smart beta strategies, like focusing on lower volatility stocks, might offer a smoother ride compared to market cap weighted ETFs, potentially reducing overall portfolio volatility. Here are some additional points to consider. Smart beta ETFs are still relatively new compared to traditional market cap weighted ETFs. Their long-term performance track record might be shorter. The effectiveness of a smart beta strategy depends on the chosen factors and how well they are implemented by the ETF provider. Smart beta ETFs might come with slightly higher expense ratios than traditional market cap weighted ETFs due to the more complex selection and weighting methodology.